You fell behind on your mortgage, you went to the bank for help, they told you to apply for a loan modification, then denied you. I'm going to teach you what you did wrong and how you can save your home with a loan modification. I'm going to tell you about my client Walter. Walter was a 55-year-old man, recently divorced, had 2 kids. He fell behind on his mortgage because he got laid off and he had some rough times. When he went to the bank told him, you don't make enough money, you don't have the right paperwork, you don't have enough income, and they denied his loan modification. Walter came to our office, and I'm going to go through the things that caused him to get denied so that you don't make the same mistakes. First, you have to understand the 31% rule. The 31% rule is the cornerstone of all modifications. In essence, after 2008 and the last Great Recession, the banks were instructed to modify the mortgages in a way that the borrower's payment was less than 31% of the borrower's income. Now that's a very simple concept, but it's difficult in application, which is what Walter ran into when he was trying to apply. The problem is that a lot of people have different kinds of income, and they don't understand how to put all that income together in an application. The way it works is this. If you are a W-2 employee, which means that you get a check, there's 2 ways to do it. If you get a weekly check, you multiply the gross amount, which is the big number, not what you actually get, so before taxes, by 52. Or if you receive a check every 2 weeks, then it's by 26. That number you divide by 12. That is your gross monthly income. You do that for the household. So if you have a husband and a wife, you do it for each, and then you add the 2 numbers together. The bank then takes that number, multiplies it by 0.31, and that is the payment that you can afford. If the number that you get is less than what you are paying originally, meaning that your payment will go down under the modified plan, then you're very likely to get a modified payment. Let me explain. The bank, what it's trying to do is trying to lower your payment at least by $1 so that you can afford the 31% payment. If the payment goes up, then there's different issues you have, which are very specific, and I will talk about it in a different video. But if your payment goes down, then you are in a very good position to get a loan modification. The problem is when income is too low, then you have a problem. Walter was in that situation. His income by itself was not sufficient. So when we did the 31% number, we calculated that his payment was going to be so low that there was no way that the bank would modify. Remember, the bank is not going to give you the house for free. What it's trying to do is extend the mortgage to 40 years, lower the interest, and sometimes put up to 30% of what you owe on the back end as a balloon, so you're not paying as much interest on the payment. That's what the bank would try to do. Now, in Walter's case, his income was not sufficient to meet the 31% rule. That is why he was constantly being denied his loan modification. That takes me to rule number 2. Use all of your available income. In Walter's case, he was now single. However, he was renting a room to a family member in his house for $1,000 a month. He did not understand how to use that extra income to raise his total household income so that when he applied for a loan modification, the bank would then use that income as extra income in its calculation. The number 1 rule when using this type of income is it has to go through your bank. The only way the bank will take into account renter's income or extra income from a second job is that you actually put that money in the bank. If you're taking cash from a renter and you don't deposit the money, the bank has no way of proving, you have no way of proving to the bank that you're actually making that money, so therefore the bank rejects it. In Walter's case, he was getting paid in cash, was not depositing the money. He was advised to put the money in the bank for 3 months and then reapply with this new income, which would raise the 31% and then maybe getting him to the point of an approved loan modification. The third rule with loan modification applications, and in my opinion, the reason that most people get denied for a loan modification is the lack of proper paperwork. In Walter's case, he was unable to show all his income because he did not properly document it. You need to put all the money that you make into a bank account so that when you send those bank statements to your mortgage bank, that amount of money is then counted towards your total income. your tax returns, which need to be signed. That's very important. You cannot submit to the bank tax returns that are not signed. There's also an IRS form that you need to fill out, which is included in the package, that you also have to submit and sign. All of the bank statements that they require, you must provide. All pages. At the bottom of the bank statement, it will say page 4 of 5, page 6 of 7. Make sure that if it says 6 of 7, you are providing 7 pieces of paper, both sides. If they're printed on both sides, you must produce both sides. Do not skip anything because you think it's not important. Give the bank everything it wants, and you are more likely to get a loan modification. Do not make the decision for the bank. The bank will make the decision for you. If you do not do this exactly, the bank will deny you. Remember, banks are bureaucracies. They do not think like human beings. Human beings might see, oh, well, this other page was blank, therefore it doesn't matter. In a bank's case, it has a checklist, and it must, by law, go through the checklist. And if the checklist is missing 1 of 10, you will be denied. In Walter's case, that was his problem. He did not provide all the documentation as the bank wanted, so therefore he was denied. The next rule is you must pay attention to the correspondence from the bank. Walter was ignoring his mail. It was tiring for him to go to the mailbox, to get the mail, to open it, and to see what the bank was telling him. The bank is not going to help you beyond sending you a letter. Walter did not understand this. He was assuming that by submitting a stack of papers that were filled in and not filled in and signed and not signed, that the bank would figure it out for him. That is not the case. The bank will not do any extra work for you. When the bank sends you a letter, and in that letter it says, we are missing bank statement X, you must provide that bank statement immediately to the bank. You have to be on top of the bank. The bank is not your friend. The bank does not care about you. The bank is soulless and faceless, and all they want is to get their money. And they're either going to get their money from your payments, or they're going to get their money from selling the house. You have to understand this. Walter did not understand this, and Walter had multiple denials because of this. When you submit your package to the bank, make sure that it is a complete package, and watch in the mail after you submit it for a letter from the bank stating they have received a complete package. If you do not receive this letter, you did not send a complete package, and the bank will deny you for failure to produce some part of the package. You must be on top of the bank. You must communicate with them, and you must make sure that everything is exactly what they want. Even if it doesn't make sense, even if you think it's ridiculous or redundant, do what they tell you to do, and you will get a successful loan modification. The last rule, and the most important rule, in my opinion, is never give up. Walter did not give up. Yes, he made some mistakes. He did things that were not proper because he did not understand that, again, the bank is not your friend. The bank doesn't care about you. The bank is not going to help you. The bank is there to collect its money. However, the bank, by law and by contract, by agreement with you, must review a loan modification package in most cases. By reviewing the package, if they can give you a loan modification, they probably will. But the road there is not direct. However, as long as you have possession of the home, you can apply. Meaning that even if you're in foreclosure, you can still apply for loan modification. As long as the house has not been sold at auction, you can apply for a loan modification. In some cases, even after the sale. However, you do not want to be in the position of trying to get a loan modification after a sale. You want to try to do this process as soon as possible. If you are in a COVID forbearance right now, you should be applying for loan modification. This is the best time. Walter finally got his loan modification. He did not pay for 2.5 years, but the bank took his mortgage and manipulated it, and now he is happy with his lower payment, and he is able to keep his home. So to recap, know the 31% rule. Use all the income that you have, including renter's income and other income that you have from side jobs. Submit all the paperwork that the bank is asking for in a timely manner. Make sure you're on top of your case and communicating with the bank always. And the most important thing is never give up. Have hope. Apply. Do the right thing. And remember, in the end, this is only about money. Never give up. Remember, this is your home. Do everything you can to save it. Diego Mendez, Debt Law, here in Miami, Florida. Subscribe. I will be sending out more videos on this topic, helping people get their loan modification. I've been doing it for many years, and I've helped thousands of people get their loan modifications. Thank you very much.